Todd Sachs, welcome to the show.
Thank you. I'm delighted to be with you.
You have a really good name, I must say.
Yeah, yours too. I was going to compliment you.
It's kind of weird, I'm seeing your email come through, and when I see Todd, I feel like I'm emailing myself.
Yeah, I think what's going to happen is when I'm trying to email something to myself, which I do a lot with articles, your name's going to come up, and I'm going to start sending them to you instead. So
That's right. Well, Todd, you what came to my attention is you recently wrote a book called 2008, What Really Happened. I have the book right beside me, actually. I've read most of it. I want to discuss, why you thought it was an important idea to publish such a book 15 years after 2008, but we'll get into that. I'm excited to have you talk about hopefully what we don't already know or what hasn't been talked about before. I want to dive into some of that so we can all learn something. But yeah, I think before we start diving into this and talking about the current housing market and comparing the notes between the two, give everybody just a high-level overview of your career. I know that you won an award, a prestigious award, the Elijah Watt Sells Award. You won that back in 1981, and that's only given to the highest performers who take the CPA exam. And I have several friends of mine who were CPAs, and comparing that to the bar exam or what have you for an attorney, it's a pretty hard exam to take, let alone win an award. But kind of give us a brief overview. Take us through your professional career.
yeah, I'll do that. I'll try and be real brief. If I run on for too long, just shut me down here. So we don't want to put anybody's sleep out there. So yeah, I started off as a CPA, thought that I wanted to become a partner in one of the big accounting firms, and went down that path for a few years, and then basically became fascinated with the investment world, with the idea of trying to grow wealth by owning companies or investing in American assets, that kind of thing. And so I went down the path of becoming an investment banker, started with a small firm in Kansas City where I had been working at the time, and then found my way to Raymond James, which is based here in Florida, and went to work in their real estate investment banking group. Had a fantastic experience there in the 80s, after the real estate crash out in the Southwest and Texas and other places when the oil patch economy fell apart. I kind of created and headed up what we called the Recovering Markets Program to go buy apartment properties in Dallas, Houston, Austin, other areas around the Southwest. We went out and one of the best deals we ever did was in Scottsdale, Arizona, another one in Utah, in Salt Lake City. And so that went very well. We ultimately sold all of those properties off at a profit for the investors, some of which were very large. That created a lot of goodwill for our efforts. And then we focused on creating a real estate investment trust group, and built that up during the 1990s because we foresaw what was going to happen with this huge movement of the ownership of commercial real estate into the public markets, and to some extent away from the public markets. A lot of it's still owned there, or the private markets, and into the public markets. And so, I did that in the 1990s, and then, was at had a fortunate opportunity, which was to leave. And I thought what I wanted to do was start a business. And I left, and I planning on starting an investment business at some point in time. Was fortunate to have a very good experience with my own investments right after I left. And it kind of hit me at one point that I don't have to go that path if I don't want to, which was a shock. I had never, dreamed or thought of anything like that. My dad was a school teacher, football coach, so I wasn't around those kinds of people. But it was surprisingly strong draw, and it took me a while to figure out where I really wanted to go. But after a number of years, I became, very involved in writing an economic history, and the economic history, in fact, came out of the financial crisis, where I had this, bad sense of where things were headed starting in the early 2000s, because of the deficits that we started to run, the gamesmanship that the Fed was playing with interest rates, the froth that was going on in the housing market. But I wasn't into the data or anything at that time. Then when everything collapsed and the Fed all of a sudden were bailing out things left and right, were kind of violating the separation of the economy and government, that I had experienced during almost all of my business career. And I can remember driving one of my kids to school and talking about it with them. And they were in high school at the time and saying, this is like a strange thing. I don't feel like I have a handle around where things are and where this is headed as much as I've always felt. And that always gave me a great sense of confidence in, going out and doing these different investment things. And it just kind of hit me. It's like, okay, I need to get focused on this. And so, I spent the better part of a decade. It led into a long, um, deep research into economic history that took me all the way back to the beginning of the country, some of which is discussed at the beginning of the book. And the initial idea was, oh, I'm going to write an economic history of the country, which is still my goal. But after going down that path for a little while, I thought, well, maybe that's a little too much for the first book. And maybe I had to narrow it down and just focus on the financial crisis and try and write and get something published there, and then go back and deal with, key events in a series of different books in this area. So that's kind of how all this came to be. So,
And now you spend a lot of your time writing. Are you writing the about economic history in your Substack? Is that pretty much what you're doing now?
yeah, what I've started doing, I've started a second book, which is going to deal with the Great Depression and the limited government era that we basically operated under until the Great Depression. And so I'm partway into that. But as I was doing that, and as I got involved with the publicity for this book, I decided, I really want to start working to try and build a much larger audience that I can deliver the next book out to, and also tie all of this economic history into current events and current issues, and even go a little bit beyond that and look at like some of the economic issues that are involved in international and foreign relations, in military and geopolitical issues and those kinds of things, and write research and get those pieces out and on those topics as well. So that's kind of what's behind the Substack work as well. Yeah.
Yeah, that's exciting. Well, we have all of your links in the show notes below for anybody to check you out. I want to, obviously I'm a real estate broker, and I have been serving the housing market for a very long time, over, geez, I even hate to say it sometimes. It makes me, I can't believe how long, since 1989. So obviously I'm interested in really diving into the housing market, your thoughts on that. In 2008, there's been a lot of talk about it. I mean, like I said, I want to dive in, hopefully give the audience a lot of new insight and sort of take a look at the current housing market today. I hope you're enjoying the interview so far. I just wanted to take a brief moment and let you know that this podcast is brought to you by SachsRealty.com. Here at Sachs Realty, we're committed to bringing you the best real estate education and helping buyers and sellers achieve their real estate goals. If you haven't subscribed to our channel, please consider doing so now. And don't forget, we're on every major social media platform, so you can follow us there as well. Now back to the show. To be quite factual, as someone who has traveled this road for a very long time, the ups and downs of the housing market, it's kind of, I don't think that policymakers have really learned much in regard to lessons from historical downturns, primarily the '08 crisis. But Todd, I guess, what's the reason for writing the book? What tell us, why did you decide 15 years after 2008 to write this book?
Yeah, well, I mean, you hit the nail on the head right there. I mean, it was because we still didn't have a good understanding of what really caused the financial crisis. And the general perception out there that came out of the federal research into it, and the book that they published about it, and most other sources from economists and in the political community, was that this was caused by what they called a gradual trend of deregulation that just ran too far, and the lack of regulatory oversight let the markets run amok. And that's what created all of this. And so if you believe that, then your solution is more regulation and enhanced power to the regulatory bodies, the Federal Reserve, and so on and so forth. And so, and we've been down this path before, like I noted in the book, even with the Great Depression, it was 30, 40 years before we started to really understand it was not caused by private market failure. It was caused by the failure of the Federal Reserve. There was another example that goes all the way back to the 1830s when Andrew Jackson was the president. It took 100 years to understand what really caused that. These events get caught up in political dynamics, and people have preconceived notions, and they create, even economists and academics, and they look at the facts in a way that confirm those notions. And you've got to go back and create a much more unbiased approach to this, which is what I committed to myself. We were talking about, when I was with my son in 2007, I said to myself, I'm going to do this research, and I'm going to write what really happened. That's where the title of the book came from, regardless of what it says. If it says that we should have free markets or we should have more government or whatever, I'm going to do the research, find it, and I'm going to put it out there. And so, we still don't have a clear understanding of what really caused it. We think it was deregulation. And as I point out in the book, the way that we can know just up front that that's wrong is we have to ask ourselves. We have had housing markets, as I'm sure you're aware, that for 100 years worked beautifully. So much so that the general belief was a national housing bust would never happen. Because housing was thought to be a local and regional market. And so you might have something like I was talking about earlier, where the oil collapse, the oil patch collapses in Texas in the early 1980s. And so you have a housing bust in Houston and Dallas and those markets, but it doesn't spread and affect the rest of the country. It was thought that it was going to be localized like that. And so if general deregulation was the cause, then you have to ask yourself, well, why haven't we had series of these events at different times in history? Why did it happen in the 1990s and 2000s? What was unique to that period of time that suddenly caused something that throughout history, had never happened before, which was a national housing boom and collapse kind of thing?
I'm so glad you said that. I am tired of people saying that, oh, well, it was because of the liar loans or because of the subprime market and yada, yada, yada. I mean, there was a lot of market manipulation in general. And it seems like what happens is these policymakers, they create an environment for these things to go wrong. And then what happens is when it does go wrong and when they lose control of it, they blame something it's not. And then what they do is they utilize that to actually implement more controls. And this is the problem.
That's exactly what happened here. And so, if we go back to, what were the unique things? Why that let's answer the question that we kind of just raised, which was, this hadn't happened. Housing was thought of as this cornerstone investment, the foundation of most young families' ability to try and build and create some wealth for themselves. Even people like, Europe and the Northeast, Peter Lynch, the old famous mutual fund manager for Fidelity Investments, ran the Magellan Fund, was probably the most successful mutual fund stock picker in history. He wrote a book a long time ago called One Up on Wall Street. And he says in the books, the first thing you should do is buy a home. This is a stock picker. And so, that's kind of how deep the belief in the American housing markets was throughout history. So let's go back. What changed? Well, what changed was the first thing. In 1998, or in the mid 90s, I should say, we had these two housing entities called Fannie Mae and Freddie Mac that were government-sponsored enterprises. They were created by Congress in their modern form. Fannie Mae was actually created in the Depression, but in its modern form, it was created in the late 1960s and early 1970s. There's a lot of history there we can go into if you want to, but to try and stay on point now, when they were formed, they had special government privileges that allowed them to borrow more cheaply than other financial sources in the marketplace. So they had a built in competitive advantage. But at that time, they were very small players, probably represented somewhere south of 6 or 7% of the national housing finance marketplace. And I say probably just because there wasn't specific data on them. You have to look at general government sources. And so they were a non event at the time they were created, but they had this special privileges that allowed them to borrow money more cheaply. Well, if you can borrow more money cheaper in a finance business, you basically have a leg up on everybody. It's like you have a lower cost of goods sold in manufacturing than everybody else. Then you can provide the product more cheaply. You're going to get a lot of business over time. And that's what happened with them. So that over the decades, um, they expanded. Congress continually increased the size of the conforming loans that they could provide. They were supposed to be out there for low and moderate income home buyers. And by the time we get to the 1990s, I think what everybody basically missed was they had become the 800-pound gorillas of the housing market. So now we had all of a sudden, instead of having housing finance spread around the country and diversified among a lot of private market providers, banks, savings and loans, and others, we had a highly concentrated into these two entities. By the mid 90s, they represented in the neighborhood of 45% of all single family housing finance. So this was the first big thing. We had, for the first time, two entities who, in their actions, could basically move the national housing markets in a way that had never been the case over the previous 100 years. And then starting in 1998, they went on a mission to dramatically grow the amount of housing finance they were putting into the market. And if you go back, which I do in the book, and you track their book of business, which is the term they use, it doubled. Their growth rates were running in the 7%ish, low 7% range up until that time in the 4 years before 98. And then in 1998, it suddenly went up in 1 year from like 7.5% to like almost 15%. And it stayed at that level for the next 4 or 5 years. And so what you then see, if you go back and examine the housing data that's out there, the housing indexes, that is exactly the year when housing prices lifted off from the long-term trend, which was over long periods of time, they basically have grown with inflation. In some markets where there's, tight and constrained supply, it might be higher, but nationally they had grown with inflation, and all of a sudden we see housing prices growing well above the rate of inflation. So that's, what I call the acceleration phase of the bubble. It happened because Fannie Mae and Freddie Mac in 1998, after becoming the 800-pound gorillas, embarked on this massive increase in housing finance.
I want to take us back to, while we're talking about Fannie and Freddie, back in 2008. Well, I guess in 2009, the acting CFO of Freddie Mac, David Kellerman, committed suicide. He was the he became acting CFO in 2008, but he actually started working for Freddie Mac in 1992 as their financial analyst and auditor. And apparently the day before he died, he went to resign, and his resignation was refused by the then human resource chief. I guess by this point in 2009, they really knew that the crap was hitting the fan. What do you think was, what do you think they were realizing? I mean, obviously this acting CFO takes his life. What do you think was happening? What was going through these government-sponsored enterprises in 2008?
Yeah, well, so they failed. When the housing bubble collapsed, um, which started to happen in 2006, what we started to see housing appreciation, like we talking about, was traditionally running at about inflation on a national basis. And over short and long periods of time, it was tracking right along with inflation. So that means 2 to 3% a year kind of thing. Well, all of a sudden, when Fannie Mae and Freddie Mac start massively expanding their book of business, housing prices start growing at 4 percentage points above inflation, which is may not sound big, it's huge. And then in the early 2000s, the Federal Reserve got involved in the game. They push interest rates down to historic lows. And that's what created, you were talking about the liar loans and stuff. Um, that's what created this huge demand for short term variable rate or adjustable rate mortgages, ARMs as they were called. The Fed drove short-term rates down to historic lows, and it created this unique dynamic where the interest rate on a mortgage was below the appreciation of the home, which supercharges the return on equity that occurs whenever that kind of dynamic develops. And so that brought, you know, billions of dollars flooding into the market through these short-term variable rate loans. And as you were talking about, it led to the bad practices. Those things did happen. But again, why did they happen then? And why weren't they happening 10 years earlier, 20 years earlier, 30 years earlier? They were happening then because Fannie Mae kicked off this housing appreciation. And then the Fed made this huge mistake with short-term interest rates. Well, when the Fed increased rates in 2006, started trying to normalize them, that's when everything started to collapse. Housing prices at first decelerated. They had reached a peak of almost 10%, which was like more above inflation, which was like comparable to what had happened over the previous 100 years before the bubble took off. Um, they decelerated and then they actually started declining. When that happened, we started seeing major financial institutions around the country at first experience severe write-offs and then going into bankruptcy. This would be Bear Stearns and things that were happening, the big prominent ones. We had the first bailout of an investment bank in the history of the country. And then in the summer, Fannie Mae and Freddie Mac both collapsed. They needed massive infusions of capital from the government, which they got, and they were effectively put into a conservatorship. And so, it was very clear that the whole mission had been an utter disaster. And most importantly and unfortunately, it was an utter disaster for the people who could least afford it to happen and who were supposed to be the beneficiaries of all this increased housing finance in the first place. Keep in mind, the mission of Fannie Mae and Freddie Mac was to provide financing to low and moderate income home buyers so that they could participate in the benefits of home ownership. And by overdoing it, they pushed the markets to heights which caused it to collapse after they pulled all these people in at the worst possible time. And millions of people went through, foreclosures and a loss of their investment, loss of their home, loss of jobs if they worked in the finance industry, all these kinds of things. So that, the outcome was disastrous.
Well, but taking you back, and that's a great explanation of what happened and how it evolved. I mean, obviously, Freddie Mac was created to be a competitor to Fannie Mae, right? You couldn't
Yes.
have one government-sponsored enterprise all by itself. You had to have a competitor. So they both equally participated in grabbing more and more market share of the amount of loans that they were financing for single-family homes, right? And even beyond, I think maybe Freddie Mac, I mean, you would know this better than me, but maybe Freddie Mac also has more of those investor type products. I don't know when they came to be, but what do you think was going through a CFO's mind? Someone who had been with Freddie Mac since 1992 as an auditor and a financial analyst for them before being appointed or, as their interim or temporary, whatever, CFO in 2008. why would he go in and resign? Number one, I mean, yeah, I know it's imploding, but do you think that there was more where they were looking at, more of the finger pointing, that they were going to start charging people? I mean, do you think there was anything that was found to be at a uh, level of criminal intent? I mean, what do you think was really going on in
Well,
these executives' minds as
yeah,
the whole thing's collapsing? Is it our fault? Are we being told it's our fault? Are we going to be pinned on this? I mean,
I think all of that's possible, but I don't know for sure. And so, but what we do know is, and this happened much earlier, actually, in the early 2000s, both Fannie Mae and Freddie Mac, were accused of engaging in misleading financial reporting and accounting practices, and they were investigated by OFAO, which was the congressional body that was created to oversee their actions. OFAO obviously failed in its mission also to prevent things from running out of control. But OFAO came to the conclusion, that both Fannie Mae and Freddie Mac had engaged in misleading accounting policies. The CEOs and I think the CFOs, I'm not sure about that, 100% sure, but the CEOs were both forced to resign and or dismissed as a result of that. New leadership was put in place. It did slow their growth rates down a little bit. So they went through almost every form of failure during that period of time from the 90s through the 2000s, from internal accounting failures, from the massive failure of their missions, as having been designed to help low and moderate income people accumulate wealth through housing ownership, and then, you know, creating programs that were disastrous for the people that were supposed to be helped, to, you know, creating the most significant financial collapse and panic in the country since the Great Depression. I mean, it would be hard to find failure on a greater scale than what they were sitting at the center of, along with the Federal Reserve, which has never acknowledged its responsibility and its role in all of this. Fannie Mae and Freddie Mac couldn't help but acknowledge it because of these accounting issues, and then they failed and they went into conservatorship. If it hadn't been for the bailouts, they'd be done. So I don't know exactly what was going through his mind, but certainly, that was just a disastrous period for anybody involved with those entities.
I want to talk about the current housing market. Before we do that, I want to go over in your book, you had shown where there's actually a lot of charts in the book. It's very good job, by the way. Very nice job in laying this out and presenting the information. It was an easy read. I would have finished it if I'd had another day, but knowing that we were podcasting together, I wanted to dive into it. But one of the charts that you had shown, and when previously you just spoke about home prices over a long period of time. Let's just say from a period of 1897 to 1997, for 100 years, when you had just spoken about inflation, 2 or 3%, this was the average home price appreciation, inflation during this period, with a few exceptions. But salaries or income levels, annual income, seemed to follow that as well. So yes, it was something that you could bank on, that your home's value would increase to keep up with inflation, right? So that you could sell it for more than what you paid for it. But the important thing here is that the incomes kept the same pace, right, for the most part. There were a few exceptions. There was, the period during World War II. There was the period during the Great Depression. And then obviously home affordability. There was a period in the 70s, the super high interest rates, the 70s into the 80s, where we had double digit, and I think mortgage interest rates maxed out at about 18%, and that certainly affected affordability. But home prices were still on that same trajectory of keeping up with inflation, 2 to 3% a year. that all changed. But what happened in the GFC, which you pointed out, was that it became out of equilibrium. We hit a peak at about 2006. I can remember as a builder and a home renovator, we started seeing the prices coming down in about 2005. But ultimately, home prices dropped to get back into equilibrium with that 100-year running average, which meant that those home prices declined.
Yes.
Where are we today? What is your opinion of the housing market? And can we see another one of those adjustments to get us back into that equilibrium?
Yeah, I mean, great questions. Look, and you're right. You were getting at this in exactly the right way, and I want to expand on that a little bit. You know, markets when they work because there are all these different dynamics that mesh together in a sustainable way. And so, like, you know, people's incomes are growing at certain rates, and housing prices, and which reflect construction costs and the ability of people to afford a home, which is dependent on their income, the price of the home, and mortgage rates. And all of these things are synced up through market forces in ways that people just don't appreciate, but that keeps them in balance. And so when you start to have these manipulations taking place, like we talked about, where the GSEs decide they're going to push all this money into the marketplace through mortgage loans to push prices up, and then the Fed pushes interest rates down, it destroys all of these interactions that are happening beneath the surface that keep things in balance, and it pushes things, out of whack. And so you're right. Housing prices, I think the easiest way to think about it, let's keep a super simple example, which will date me. You were talking about being dated earlier. It'll date me if we talk about housing prices. Let's just say we had $100,000 home as kind of the inflation adjusted norm. Like that's where things should have been. Well, what happened as a result of all of these interventions during the housing bubble is that price got pushed up to $180,000. So if 100,000 was kind of the natural market clearing level, we were pushed so far away from that it was like a disaster in the making kind of thing, especially given the nature of financing and stuff. When the collapse came, that got back down to around about a 30% drop or so. I think it got back down to 130, 135 or something. But then what happened, and this goes back to what we were talking about earlier, and not learning the lessons of what really caused this. When we get in the 2010s and the Fed is trying to supercharge the economy and the recovery from the Great Recession that followed all of this with these super low interest rates again. And so what do we see is instead of readjusting back to the inflation adjusted market normal, housing prices start escalating again. And today we are back to prices that are, roughly the same kinds of levels that we were at the peak of the housing bubble. So that doesn't mean we will have a collapse again. There's an old saying I refer to in the book, which is, history doesn't repeat, which means it doesn't happen exactly the way it did before, but it does rhyme. So you have the same circumstances, you might have different problems or different results. So lending practices are not as crazy and out of whack, at least from what I've seen this time around. So we may not have an immediate collapse in housing prices, but we have a whole new set of problems, which are home affordability issues. Because as you were referring to, housing prices are out of whack with respect to incomes. And so, if you haven't been fortunate enough to own a home through this period of time and benefit from all of that, so you can sell it off, and sell one highly priced home and then reinvest the money in another highly priced home, that insulates you from from all this a little bit. But if you're a young family starting out or anybody in the, working career and you don't own a home on today's incomes, it's almost impossible to buy a home. And so, we have a massive affordability problem right now with housing. Could it lead to another significant correction like we started to have last time? It could. Nobody knows. Um, but we could also just end up in a period where we go through a very long period of time where housing prices just don't appreciate at the level that they had before. And so, I think those are things for people to be aware of.
When you talk about not having the subprime market like we had before, and you mentioned that history doesn't necessarily repeat itself, but it rhymes. Would you agree that FHA and even as far as going with the GSEs, Fannie and Freddie, because it seems like they've lowered their standards, would you argue that they are the new subprime market?
Well, I haven't followed them as closely as I probably should have since then. But what I do know, and we do know, Fannie and Freddie are still around, and their share of the housing market is bigger today than it was even in the 2000s. I think they're up in the 60% range of the housing finance. Now we were talking about they were 45 to 50% when all of this got going. So they have become even bigger players in all of this. And, this is another factor of having not learned the lessons that we should have learned. And so, you know, and again, I'm not as into the granular details as you probably are and others are here, but I just don't have the sense that the lending practices are as far out of whack with the adjustable rate. The liar loans, lie about your income, anything will get approved as they were at that time. I might be off on that, but doesn't feel that way to me. So it doesn't feel like we are quite as much of a risk of an imminent and severe collapse as we were last time. But we do have these other problems, which is you push prices out of whack relative to incomes and affordability and those kinds of things. And that leads to these other issues. And so now you hear all these people talk about, oh, we have an affordability crisis that the government needs to solve. You know, we're going to create all these programs to get home building started. They're going to fund home building and all these kinds of things. What's the last thing we should do? We need to get back to the market dynamics that worked for 100 years and get away from it. I'd be in favor of not only of either completely breaking up and liquidating Fannie Mae and Freddie Mac gradually and getting them out of the market completely, or at least breaking them up into a number of much smaller enterprises, completely revoking their government privileges so they have to compete on the same basis with everybody else in the lending finance business, and removing the government as much as possible from all of this.
Well, the Trump administration has already said that they will continue to back the mortgages should Fannie and Freddie be privatized, which I think is on their agenda. I think that would reduce their rating. Their bond rating would drop, certainly. And probably interest rates would go higher, mortgage rates. So maybe homeownership rates would decline. But what about the fact that we have been essentially, what's going to happen when people eventually have to pay their mortgage payments?
Well, I go back to, and I've talked about this in the book also. If we were talking about Fannie and Freddie getting created in their modern form in the late 60s and early 70s. And, you know, the government played a very small role other than through, the banks and the savings and loans, which had, government guaranteed deposits. But the government wasn't directly involved in the housing markets, you know, after the Depression and, after World War II. And yet we had this incredible single family housing boom that happened from the end of World War II, which, for everybody, that may not remember those days. I wasn't alive then, but that's the mid 1940s that I'm talking about. So from the 40s all the way up to the late 1960s, we had incredible housing markets without the government playing a major role. I think the number was, housing finance without Fannie and Freddie, and with the government still, below 6 or 7% of the whole picture, grew at something like 10% a year throughout that period. So if the natural demand is there, and incomes are growing and the economy is doing well and the jobs are there and interest rates are at reasonable levels because we've got inflation under control, you know, the private markets can provide all of the money that is needed to meet the demands. It's only because we went down this disastrous path that it now seems like such a dangerous route to take, to take them out of the picture here. So we would need an adjustment period, but I have every confidence in the world we'd get back to very healthy and functioning markets. We would minimize the risk that we have another major collapse. We would reduce the risk that we create affordability problems like we have right now, and we'd be much better off if we got them out of the picture.
In the state that you live in, you're seeing this a lot. Their home prices are coming down in Florida.
Yeah.
You're aware of that, right?
Yeah.
I mean, you know that. The inventory is sky high. I mean, you're probably second in the epicenter for what we're talking about here. The potential for a home price decline or another bust. A lot of people have purchased homes since 2020. We saw the most home price appreciation between the years of 2021 and 2022. That was the biggest jump, and it continued. But when the Fed started to raise the rates, the Fed rate, it impacted the bond markets, which impacted the mortgage rates, caused them to rise. So we saw a slowdown in sales, but we didn't see a slowdown in adjusting the home price to the now double interest rate of what you could buy a home for back in 21 when we got down to about 2.74% for 30-year fixed rate mortgage. Home prices are still priced at that 2 and 3 handle. Now that we see where mortgage rates don't look like they're coming down anytime soon, if you want to buy a house and you're looking at the existing home prices, the numbers don't work for pretty much most of the middle class.
Yeah.
Let's just say that they have to sell their home. They're going to have to drop their prices. This is going to change the new comps, the comparables, because appraisers, if you need financing, you have to go off of what recently sold. So a couple, what would seem like outliers, they dropped their price, are now your new comparables. Moving forward, now we start to see this home price depreciation, which doesn't work in America. We have no reverse gear in our economy, right? We're not set up for deflation. We're only set up to continue to increase prices. That's how our financial system is based. If we have a home price correction, you say that, and I'm with you, we don't have the type of loans that we had before that set people up to fail. Well, you could buy a second home and get a bridge loan and do this and do that and interest-only loans. However, we still allow people to buy houses VA 0 money down, FHA and conventional 3.5% down payment, of which a lot of working class families or people that buy houses put down the minimum amount.
Yeah.
I mean, you can argue that over the last couple of years, there's been a lot more cash purchases because of the cost of finance the home. If we have a home price correction, which it looks like we are now, it's spreading like a contagion all over the country. Home sales are dead in a lot of the major markets. What do you see happening with no reverse gear and one more step to that? One of the reasons why people turned the keys into their homes wasn't because they couldn't afford their mortgage payment. I saw this firsthand.
Yes.
They were turning it in because the house across the street was worth $100,000 less, or their home, the same as across the street, you could buy for $100,000 less than what you owed on your mortgage. And people were like, well, screw that. I'm not going to keep paying on this overpriced home. It's not worth what I owe. So they defaulted because of that. That was a thing. How will we behave as homeowners now with debt, consumer debt way higher than it was back then, with home prices way out of the equilibrium of what people can afford as a 3x or 4x of their median income, being able to buy a median priced home? We're way out of that equilibrium in most of the country. How will homeowners behave if that were to happen today, where home prices by scale drop lower than their mortgage balance?
Well, I know you are exactly right about that, and that was a major factor back in the day also. I mean, when you're buying these homes with little bit down, uh, and largely predicated on the idea that it's gonna be growing 7 or 8% a year. So let's go back to that example. You got a $100,000 home, you put $3,000 down, you have a $97,000 mortgage, and you just because of what's happened for the last several years, you think next year it's gonna be worth $110,000, and your 3,000 is gonna be worth $13,000. And that holds all these people in until what you're describing happens, which is instead of it continuing to escalate, all of a sudden now you're in this last wave and you've got the $100,000 home and the $97,000 home, and the one across the street is worth 90,000 and it's going down. And if that's happening, you have no incentive to continue plugging that gap or trying to hold on to that ownership. If you think it's going to turn around quickly, you do. But if you think it's going to continue to go down, you have to walk away from it. And so I think you're right. I mean, look, these things in real estate and in housing, they happen in a little bit more slow motion unless a debt problem forces it to happen more quickly like we saw last time. But this takes me back to what was happening with, apartment buildings and stuff out in Texas we were talking about earlier when, I was running around buying those properties back in the 80s, during the 1980s and after the oil collapse. It took a while for that inventory to come into the marketplace because everybody does base their expectations off of comparable values. And so if you saw the guy, you saw high prices moving up. Let's go back to our $100,000 example. And the guy across the street sold his home 6 months ago for 102,000 or 103. Well, you list it for maybe 104 or 105. And it takes a while for the market to send you the message that that's not the market anymore. And 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 so so first you lower your price a little bit. But these things take time, and it takes until the house price then actually comes all the way back down below the level of the mortgage before you're gonna walk away from it. So, I think we will if this continues, I think you're hitting on a great point. We will see this unfold maybe gradually, depending on how over-leveraged we are in housing, for a period of time, but it will also be affected by what's happening in the economy at large. And so the other huge problem that we've had, for the last 20 years, as all of these misguided policies and others that we haven't even talked about, but I've been writing about in the Substack pieces have been taking place, we've had anemic growth in this country. You know, this is a country that from the founding until the Great Depression grew at 4% a year over the rate of inflation. Those are extraordinary growth rates. When the Reagan boom got going in the 1980s, which extended through the Clinton years in the 90s, we were growing at 3.6% a year. For the last 20 some years, we've been growing barely over 2% a year. So one of the major initiatives of the administration is to try and jumpstart that. Hopefully they'll be successful. And then I'm of belief that what's happening with AI, with artificial intelligence, could create a phenomenal wave of growth if we can unleash that. So if those things happen, that's a big if. But this is a country that's had those kind of things happen before. Let's just come back around and put it in a little bit more maybe realistic terms. if we can get back to the kind of growth rates that we have had and experienced before, 3.5, 4% a year kind of things, because of a new approach in the administration and these dynamics that are happening in the economy, that will impact these issues also, because that will start getting incomes growing again, and it will start helping with the affordability issue. Can it solve it? Home prices are so high right now, it's not going to solve it in a short period of time, but it may help with this issue somewhat. So we'll just have to see how all these dynamics play out.
Well, you're right. I mean, if we can get the growth, the economy to grow at greater rates, we can certainly hack away at some of this debt if, in fact, you actually stop spending or control the spending in as relative to that growth, right? If you
Yeah.
continue to spend more money than your growth, I mean, any business can do that and fail. It doesn't happen to the government, but it does happen to businesses. If you say, I'm going to add all these products, or I'm going to buy these companies, and I'm going to add to my growth, but as a result, it's going to bury me in more debt, that won't work. But you're right. I just had to laugh when you were mentioning AI, because you say that AI can help you. I have news for you. It can also take your property value down to zero if a freaking AI data center is built right across the street from you. We're seeing this in the news where, man, this is a big issue where, I mean, they should literally have to go. I mean, they should need to go in and buy all the houses in a 1 mile radius, maybe, around these data centers, pay everybody market value or above for their homes, because what we're seeing happen with the noise pollution, the sound pollution, I mean, it's in the news. You can Google search it. Water's being, they're saying that water's being contaminated. I mean, I don't, that's at least what they're talking about, right? Whether it's true or not, that's what I'm hearing. But I want to get back to a couple things, because I want to talk about what I meant when I said about FHA, questionable VA, Fannie and Freddie dropping lending standards. I don't just mean literally saying, okay, well, if you have a 600 credit score, 630 credit score, you could buy a house. Or the fact that if you had a bankruptcy in the last year or 2 years or whatever it is, every one of them are different, then, hey, you can turn your keys back in on your overpriced home. You made a mistake, and go rent somewhere for 2 years, and we'll finance you again very soon. So these are regulations that really incentivize people to say, you know what, I want to have a clean slate. I don't want to pay for this house. It's worth less than my mortgage payment. So there's that. Then there's the fact that we over allowed for people to not pay their mortgage payments for a long period of time. Now, look,
Yes.
I mean, that's crazy, right? So that's manipulation, right? That takes subprime lending to another level. When you cannot pay your mortgage, and we're going to modify that mortgage, but not for everybody. We're not going to do it for everybody. We're only going to do it if you stop paying your payment. That incentivizes people to, hey, well, I could have a second mortgage with no interest, where they'll take a third of my mortgage balance, dump it on a second mortgage that has zero interest. I don't have to pay off until the end of my 30-year note or 40-year now note. They extend it to 40 years, and I can get that. I can drop my payment down. Well, that's great. I want to stop paying my payment. I mean, these are incentives that, okay, maybe private sector wasn't able to do or couldn't do, but certainly the government can do, right? I mean, they can do that. Am I wrong on this?
You're exactly right. And this is just another version of the same mistakes that led us into all of this. This is the idea that intervening in these markets and changing these dynamics, telling you don't have to make a payment, or you can make a low down payment, or that we can push more money into the market, or we can subsidize and get interest rates down. All of these things that we will make it better for you, they create disasters. But what they do is they make the economy look better than it really is while they are in process and before somebody has to pay the price. And so this went on with the housing bubble. This is, you know, in the late 90s and the early 2000s, you know, when housing was going crazy all of a sudden and there was all of this stuff happening, it made everybody feel wealthier. They were spending more money than they would have been. They, they were borrowing against the rising value of their homes on home equity loans. All of these things make the economy look stronger than it actually is. And so whether you're a Democrat or a Republican, it's why all of a sudden everybody likes the idea that the Fed should be pushing interest rates down to the lowest level possible all the time, because it makes the economy look better during your administration. It's the one bipartisan thing everybody agrees in out there. But but I agree, all of these manipulations ultimately end up hurting the people that they're supposedly designed to help the most. And they don't work. So,
Yeah, and what it does is it creates the asset price of a home to a level because of all these subsidies and because of all these bailouts of the ones that aren't paying their bills or that are working the system to not pay their bills. And it's penalizing the ones that are paying their bills and that could pay their bills or could buy a house if the prices would adjust because, we let the bad things that the equilibrium balance, and instead of just putting a Band-Aid on it and bailing out the ones that aren't paying and penalizing the ones that can, can't afford a home.
yeah, exactly. I mean,
That's what's
you're saying it exactly right. It keeps pricing from adjusting to market equilibriums where it would work the way it has in the past, where you get a good job, you work hard, you make this much money, then, you can afford to buy a home of this price with a mortgage of this amount and an interest rate at this level. And you can, your home payments with principal amortization and a long-term fixed rate mortgage are going to fall within a range of your income that is sustainable and works over time. That's the way housing basically worked for 100 years up until we went down this path that we've been talking about. And they bring it full circle to what we started off with. Because we didn't learn those lessons, we have stayed on that path, both with interest rates and some of these other interventions that you're talking about. And today we have an affordability problem that is keeping prices from adjusting to the levels that would get all of these dynamics working again. That's absolutely right.
Todd, I want to ask you a question. And you had said in the start that you had been involved in purchasing apartment buildings in various states. As a real estate person and investor, I believe that Wall Street, your major corporations, that is their space. Commercial real estate, buildings with more than 4 units, apartments, that historically has been, and because, look, they do a great service. You need apartments. There are people that want independent living out of their parents' house, and they're not necessarily ready to own a home. So you need rentals. And you also need, in my opinion, a certain amount of detached homes and townhomes and of the like for people that want to have families or live in that, detached home environment, become rooted into a community that can't afford to buy. So there is a place for that type of investor as well. The question what I want to ask you is, one of the issues that I have seen that has been a major problem, and it happened around that 1997 mark. My experience anyway, is that I watched a whole lot of real estate investors get into the market and teaming up with the HGTV shows that were prime time of flip this house and this kind of thing. And the stock market had crashed prior to this. And people were taking their money if they panicked and took it out of the stock market, and they were investing it. I saw my neighbors on the street saying, I want to invest in a house. It was like, whoa, I knew something was out of whack at that point, right? Like, you don't know anything about this. And this started this phenomenon. But what happened in 2009 when Obama took the reins of the collapsing economy, right? I mean, a lot was happening at that point. You talk about it in your book. For the first time that I can remember, at least hearing about it, we bundled up these single family homes and sold them to Wall Street. They were foreclosures, 4 million plus foreclosures, what have you. Was that a good idea? And what do you think the investment or the financial markets role, the Wall Street companies, the hedge funds, the insurance companies and the like, that the REITs that have gotten into single family housing, are they major contributors to where we are today with unaffordability?
Yeah. So let me preface this by saying I didn't talk about before, going down the business and career path that we talked about. But I came from a lower middle class kind of family. I still relate to the world in that way. I was in Wall Street for reasonably long period of time, but I've been away longer than I was there now. So I still look at this from real America's perspective. Having said all of that, in spite of all the things that we hear about Wall Street, um, you know, I think to me, it's a lot like our legal system. There's flaws. There's isolated cases you can look at that are disasters and can make you think, Jesus, this whole system is just, a con game designed to screw everybody. But I think from the big picture perspective, we have the best financial markets in the world. We have the best legal system in the world. We are very fortunate. And I think on balance, this doesn't mean there aren't major exceptions and issues, that we could find, that contradict what I'm about to say. But on balance, they play a healthy role in this. And so, what they're out there to do, as long as they're not getting government funding, some kind of privileged status like Fannie Mae and Freddie Mac had. But if housing prices, there's such an excess getting dumped on the market at a particular point in time that they believe prices have temporarily dropped too low and they step in to start buying, that helps bring prices up a little bit and helps markets find an equilibrium kind of level. So in general, as long as those things aren't government subsidized efforts and and they're not going to get bailed out, I think that's generally a healthy part of the marketplace. So
What
I
about
go ahead.
well, I just want to push back on that a little bit. What
That's
about when they're
fine.
playing with money that's not theirs and their losses don't implicate them at all?
Yeah, the interesting thing is, ultimately, they are accountable to their shareholders. And those Wall Street investment banks that collapsed during the financial crisis, the executives in those companies owned hundreds of millions of dollars of stock. It doesn't mean they were wiped out like the average person was. They weren't when they got bailed out, but they took huge losses. Significant amounts of their net worths were wiped out. And appropriately so, because they made the mistakes. They had to live with the consequences.
I guess I'm
So
not talking about that scale, though. I'm not talking about that kind of scale. I'm talking about um, a uh, a a home buyer, institutional home buyer that buys up tens of thousands or hundreds of thousands of single family homes, gets paid to manage the homes, raises a whole lot of money. The stock prices go up. They make a ton, and then the stock's prices decline. That's not a complete bust. That's not a failure, but a lot of people lose money. There's no implication. You invested your money, you gambled, you took a risk. Look at the stocks. They're down. If you invested in the height of 2021 and 22 when they were buying like crazy and you thought that the top would never come, you threw a lot of money into it and then the stocks dropped 30, 40%. You lost your money. These groups still own the homes. They still are basically unscathed with their assets at pennies on the dollar. I mean, is that a wrong analogy?
well, I don't think it's completely wrong, but I also think, if if they form a company, they go into the market and they buy these single family homes with the idea that they're going to rent them out, that kind of thing. I think that's what you're referring to. I mean, they've got to perform over time, or their stock prices will be adjusted downward, and they won't have any more access to capital. And if they've over leveraged and they bought at too high of prices, the same thing will happen to them that would happen to a normal home buyer. I think normally in those public market situations, they're dealing with much lower levels of leverage. Uh, I haven't looked at those companies specifically, so that insulates them a little bit, but their stock prices will very quickly reflect what's happening, and that will affect their access to capital, their ability to grow in the future, and the role that they play in the overall housing markets and that kind of thing. So again, as long as the government stays out, I'm pretty comfortable with the idea of having different forms of investment taking place in the housing markets, and I think all these things will help adjust with each other.
Yeah, well, I I have to respectfully disagree on that one.
I
And the
appreciate that.
and the reason being is because you have areas like in Texas, cities in Texas, over 50% of the houses in 2021 were bought by institutional investors, companies. And here's what happens. They could offer things that a home buyer couldn't offer. They could offer cash. They could allow people to stay in the homes, the sellers, for as long as they wanted, within a reasonable amount of time to find another place to live. They didn't get inspections. They bought it completely as is. Maybe they sent their guy in or whatever, and they had a 300, checkpoint, whatever, and they said, okay, we'll just give you the money. They inflated the market. They were part of inflating the market. When you can borrow money for less than the consumers can borrow it, you will manipulate that market. And the result was that prices skyrocketed, and it made consumers behave. This type of activity contributed to consumers buying, and the exuberance to buy a home without an inspection, taking gift money from their mom and dad of $50,000 to $100,000 or more. And look, you could say it's the parents or the idiots that did it, or you could say, you know what, they did them a great service. I don't know how you want to look at it. You put one of your kids in a house that they can't afford, then you better be prepared to replace the roof when it needs it. You better be prepared to replace the HVAC. But Todd, I don't know, man. I disagree. I think we took a scenario. If we look at the markets, if you look at the lines of the exuberance or the increase in the home price appreciation in 2006 that got up to 97 to 2006, and you look at what happened from 2020 to now, you see a way bigger bubble.
Yeah, well, but keep in mind, there's many things happening. And in addition, there are two other points that I would make there. Is this was the period when the Biden administration came in. I mean, two things, even before that, the Trump administration spent a lot of money in its final year to try and offset what was happening with COVID. So we ran a deficit that was, I think, in the neighborhood of 10% or so that year, or close to it. And then the Biden administration came in the next year, even though the economy was already recovering, and they blew out the doors again and ran like a 12% deficit. These are just incredible, unprecedented numbers. Other than what happened with Obama, who did the same thing in his term after the Great Recession. But you go back before that, that kind of thing never happened, other than during a war. So all of this money is getting funneled into the system, and it has to go somewhere. It's just like when the Fed lowers interest rates and lending picks up, that money has to go somewhere. Some of that found its way into these housing markets and played a role. And then the other thing that's been going on that we really haven't talked about, along with all of this, as a result of these low interest rates, stock prices, like housing prices, are very high relative to historic norms right now. You know, roughly, maybe not quite, but close to double the long-term average PE ratios, where prices relative to the earnings that the companies generate. So one of the things that you're getting at that was hitting me that I hadn't thought about before as you were talking about that is these Wall Street funded firms were benefiting from the ability to raise money at very high equity values that are also out of whack with historical norms, and then come into the marketplace and use cheap equity financing to purchase homes. Where the expectations of equity returns are much lower, but given where prices are than normal. And so that probably happened for a while. But I just believe that, coming back to where I was before, those things in a normal market functioning economy, those things get sorted out. You buy too much at the wrong price with equity that is temporarily high, and it doesn't work, and you can't deliver the earnings and the growth in the asset values. Those things show up in time. Your stock price gets hit. You can't go back to the market and raise more money. And so that limits your ability to play a role over a longer period of time. And
Yeah.
so to me, that's how markets work. Maybe in the short term, you have some of these issues, but yeah.
Look, Todd, I don't disagree with you, man. When you're buying when you're opening up stores around the country and you're buying product, and you buy a whole bunch of product, maybe from China or whatever, or a local manufacturer, wherever you overload in your product, you over purchased, you paid too much for it, the market shifts, they don't want your product anymore. That is all fine, and the business will collapse, and that's great, but they didn't take anybody along with them that will become victims of the exuberance. And that is the difference that I see in the housing market, is that when they played this game, okay, yes, if they overpaid, it's going to hurt them, whatever. They're not going to be able to get more money. But what about the millions of consumers that overpaid as a result of what you did, that's in a 30-year mortgage in a depreciating asset called a house, where things break and need replacement? And now they're enslaved to this debt. So as their little game of market manipulation, or trying to bet on something happening, it affected millions of other consumers that are still paying their bills, even despite them fire selling their assets, realizing they made a mistake. That's what I see in the everyday lives of the buyers and sellers that we deal with, and the stories that I hear across the country.
Well, look, it's a good and a fair point, and obviously, the markets don't always work perfectly in every situation, and there are winners and losers, and sometimes it's not fair the way those things, or doesn't seem fair the way those things are getting divided up. I do think it'll work its way out over time. To some extent, people were selling, and the people who were selling homes were getting a little bit higher price than they otherwise would have, so they got some benefits out of that. But look, I am with you. Um, to me, the basic issue comes back to the manipulation of the financial system through government interventions with historically low interest rates, which inflate housing prices and equity values, and with this massive deficit spending that we saw under Obama, and then especially the Trump thing as a reaction to COVID is a little bit more understandable. Overdone, probably in retrospect, hard to know at the time. Biden, it clearly didn't need to happen. And all of that federal money flooding into the system and pushing up prices of homes and equity values and creating these distortions. Again, I think that is the core issue that we're really dealing with here.
Todd, I really appreciate our conversation, and I think it's a good conversation that we're having. And I'd love to have you back. And I really do think you did a very nice job on this book. I encourage people to check it out and read it. It gives, obviously we didn't want to give all the secrets away, because I think people reading it themselves, they can understand it better. But I will tell you, so thank you, and I encourage people to check out your Substack as well. It's right on your website, which is kind of nice. It doesn't go to Substack. You have your own little website. You can sign right up for the email. So check that out below. You can follow Todd. But I do want to say, one of the things that I learned, which, you say you always learn, right? And somebody who has been around for a long time, self-employed for more than 35 years, I learned something very valuable in that pandemic boom period. Do you want to know what that is?
Yeah.
I learned that money is the only thing that defies gravity. And, what it did was they printed a whole lot of money, just like you said. They overstimulated the economy. And where did it go? It went up. It went up to the elite. It went up to the massive corporations. They became richer than they've ever been in their entire lifetimes. And, that was it was something neat to learn from printing more money in 2 years than we did in 200 years. So
Eventually, what goes up must come down. That's another rule, and those things do come back one way or another.
Man, you can't see them, but I have buckets everywhere. I have kiddie pools, and man, I'm hoping that the money just comes back down that I can catch some of it.
So we'll finish with one last thing. When I started going out to Texas, I had to find a local partner for us to work with, and I found a great guy in Dallas. And he had been in real estate, his whole life for 30, 40 years. He had lived through the glory days and the downfall. And he had a sign in his office in Dallas, Texas, the first time I went in to meet with him, on the wall. And it said, God, please let there be one more real estate boom, ... And I promise not to piss it all away this time.
That's good.
Yeah.
Oh, Todd Sachs, is an absolute pleasure and honor, sir, to have you on our channel, and we hope to have you back sometime real soon.
Yeah, thanks so much for having me, and I really appreciate the questioning and the pushback. I mean, I learned something from all of that too, and so, there's nothing better than having somebody, really honestly asking questions and pushing back on issues, and I really appreciate all the time you took today, so it was great.
You handled it well. Thank you, sir.
Thank you.
Thanks so much for watching. If you liked the video, you can let us know by smashing that thumbs up. And if you haven't already subscribed to our channel, please consider doing so now. Hit that alert bell. You'll know every time we upload content just like this. Keep those comments and questions coming. And one of the biggest compliments you can do for us all here at Sachs Realty is to share our channel and this video with your family and friends. This will help us to continue to build this amazing online community with viewers just like yourself. See you next time. Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.